Hey everybody, welcome back to another episode of Ryan Makes Sense, where we talk about personal finance, investing, and chart analysis. If you've seen my videos before and you are a returning viewer, please consider hitting the subscribe button. It really helps me out. We're going to be looking at CAGR stocks that have done really well, and that is compound annual growth rate. So these stocks, we're going to look at a 3-year period, which is a very small window. Normally you would think, okay, over the last 3 years, we had, Nvidia's doing really well. Netflix went from 180 to like 450 now. There's a Meta went from, I don't remember, 100 something. Now it's at 3 something. That's not what we're going to be looking at. So the compound annual growth rate stocks that we're going to be checking out, I'm going to show you. This is a new website for me, so I don't fully understand the navigation, but we're going to look at the stocks. We're going to look at their fundamentals and see how we could have found these stocks before they rose 1, 2, 300, 400, 500%. So we're going to look at macrotrends.net. We're going to look at the top 3 to 5 highest CAGR stocks. And then we're going to dive into FinViz and see how we could have found these before they had the 1 to 500% move. Enough of me blabbing in my Hawaiian shirt. Let's dive in. All right, you guys, we are on macrotrends.net. Again, this is a new website for me. As I scroll down, we can see stock screener, stock research. My head is right in the way of everything, which is awesome. Okay. Market indices, commodities, oils, gas, precious metals, exchange rates, interest rates, economy, delisted stocks, and global metrics. All of this sounds very exciting, but we're going to go to the stock screener. If you know me, you know I am a FinViz fangirl. So again, navigating through this screener is very different for me. But one thing that this has that FinViz does not have is performance long-term. And again, CAGR is the compound annual growth rate, and the actual definition is this. The compound annual growth rate measures an investment's annual growth rate over a period of time, assuming profits are reinvested. Okay. So it's basically growing from the beginning balance to the ending balance of profits. So it's no wonder we're seeing Apple up here. We're seeing Microsoft, Google, Amazon, Nvidia. We can see that Nvidia's 3-year CAGR is 63. You'd think that'd be high, but let's do a little sorting on this. Any guesses before we do it? All right. I'm sure you picked these top 3 or 5. So we have Denbury, which is oil and gas, CBL and Associates, which is a real estate investment trust, Alpha Metallurgical Stocks, Mining, Envirotech Vehicles, CPI Card Group. All right, so we'll look at these 5. Again, these went from 197 to 595%. So now we're going to go over to FinViz because I know how to navigate this very well. The first one we're going to look at is DEN, Denbury. Denbury sounds British. It is not. So looking at the technicals here, we can see it got really hot. Look at that RSI. It got really hot. And it just kept going. We have a big bull flag here. So here's our flagpole. Imagine this is the flagpole. And then here's our flag. Then the break up. And now it's just kind of trading sideways. So how could we have found Denbury when it was around $16? Well, let's just go down here really quick and see. So it was $16 at the October 2020. So we're looking at the income. So total revenue around 2020 was 700. Wow, it got beat up. It fell 50%, and then it literally jumped right back from 750 mil to 1.2 bill. So that's a 50%. I'm just going to take notes. Okay. So Denbury 2020 had 50% plus growth. Okay. Revenue. Let's see. Gross profits. Gross profits doubled. So that's over 100%, right? So 750, yeah. So 2020 had almost 100% growth. Almost 100% plus growth. And then gross profit, same thing. Same with gross profit. The gross margins, right now it's at 63%. Gross margins, wow, not that much. So right now it's 63%. I just want to confirm. So I'm going to look right here. So I'm going to do 607 divided by 1643 times 1. I'm getting the inverse. Okay, that's why. So 63% gross margin matches right here. Pretty close. So the gross margin in 2020 was low. I mean, it was so low and then it jumped. So 2021, how would we done in 2021? 2021 right here. I mean, the stock would have been $25 then. So how could we have figured that out? I mean, we'll just have gross margins because I mean, gross margins in 2020 got spanked. Because gross, let's do 2019. So 1274 minus 496 divided by 1274 times 1. So gross margin 61%. Then it fell to like, oh my gosh, 45%. That's not bad. I mean, so gross margins went from 60% down to 40%, and it's been holding well above 60. So we're going to put gross margins over 60%, greater than 60. I don't know what I'm doing. 6 plus. Okay. So, because what I'm trying to do is we can create a filter to find this kind of stuff. Operating income was negative. It went from positive to negative. So we're going to do operating income positive. Operating income positive. Okay. Net income was positive and then it went negative. So it was profitable. So we want profitable. Net income positive, profitable. Well, there we go. Okay, let's look at cash. Ooh, they don't have that much cash. They don't have a good quick ratio, right? Wow, their quick ratio is low. They don't have much cash on hand. That's surprising, honestly. We're gonna capture that quick ratio less than 1. That's dangerous to me, but whatever. Total assets, total liabilities. So, I mean, assets dwarf liabilities 2 to 1. So I think that would be the current ratio. It's 0.7. That's not right. So assets dwarf liabilities, that's fine. Total debt, it's not that much. 2020 is when we would have wanted to get in. So it was 138, now it's 29. So I mean very low. So debt, we'll keep debt. No. We need a we're gonna use the Wayback website machine and we're gonna put a stop to the speculation because we're gonna get all facts here. Okay. And you guys, if this video goes too long, we might just do 3 stocks. Okay, so we want Denbury. So what I have to do is go DEN, and I have to get DEN. There we go. Okay. It's so fidgety, you literally have to get you have to get it before it loads, otherwise you won't get any matches. Oh, someone did take notes. Yes. All right, 2021, April 15th, 2021. So April 15th, 2021, that was here. Someone was like, all right, I'm onto something. We're going to catalog this in the website. So they had the long-term debt to equity at 0.13, and their debt, it's not going to load. Okay, that's fine. So their debt was still under 1. So we're just going to note debt is under 1. All right. Okay, going back down. Okay. All right, so I think we captured some good fundamentals there. Institutions owned a lot of this stock, 87% back in 2021. Now it's over 108. So we want institutional ownership to be over 80%. Inst ownership over 80%. Okay. Shares float under 100 million. Under 100 million. Okay. Great. All right. It's good to know. Gross margin high, operating margins positive, profit margin, yes, they're profitable. EPS past 5 years is really high. EPS back in wasn't high, so they really made up for it here. So we really can't use those metrics here because although it could crush so hard in 2023, 2022, 2021 that it will outweigh 2020. So 2020, this is showing negative. This wouldn't have been a good indicator for us. This is a lagging indicator. So we're not going to be interested in that. The current target price, it's under the current target price. That's good to know. Under current. But that is current. And what about... No, in the past it was considered overvalued. So let's remove that. We're going to remove this. I think that's RSI is 37. I mean, RSI was probably pretty hot, 66. We're not going to look at RSI. Okay, and then I wonder if we go back to here and we do... Let's go back to the Wayback Machine. Let's see if there's anything on the elite URL. I doubt it. Let's see. All right. Cool. So that's good to know. Let's look at the weekly. I mean, the RSI was very low on the weekly. And if we are doing a snapshot today, it's literally at a day. So we are going to go all the way back, all the way back, all the way back down here. Okay, so RSI, I mean, RSI wasn't too bad. So let's see. Let's reset this. Okay, so RSI, these are the teens. I want to take me all the way back, dog. Whoops. Here we, oh, yeah, this is teens. That's as far back as it goes. I mean, okay, that's fine. So daily and then all the way, let's go all the way to the beginning. Okay. RSI was below 50. Okay, that's good. RSI below 50. Okay, so this is how we maybe possibly potentially could have had DEN at 15. Margins were great, right? Based on the data we were looking at, the margins were great. Wow, they were majorly unprofitable. Wow, they turned the ship around. Okay, so yeah, down here we can see they were back in 2019, 2020. Were they profitable back then? Oh, they weren't. Oh my God, that's the one we're looking at right here on the other screen. So they were profitable 2020. So yeah, just crazy, 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 crazy. Okay. So yeah, we do want profitable. So okay. I feel good about Denbury. Let's look at the next one, which is AMR. Give us a good like 10-year stock. Oh, this one's good. Wow, look at this move. This was $2 or $4. Oh my God, it went to $100. This is going to be a really good case study. Okay, so I think we can all agree that it had a major run and the momentum's heading down, money flow is exiting, RSI is kind of going this way. So let's make this a good case study because there's a lot we can learn that we should have gotten from $3 to $150 plus. So, wow, major, major, major. Okay, so this was back in 2020, 2021. So let's look at the 2020, 2021 numbers. So, wow, their gross margins were really low, and their gross margins are still really low. 42%, really? Okay, so here it's like double. Like, here's what I mean. So if I do the 3.9 billion minus the cost of their to make money 2269 divided by 3940. So 42% gross margins, like I said, is amazing. However, 2020 and 2021, look at these gross margins. 1416, so 1.4 billion minus they paid 1.28 billion to make 1.4 billion. They had a 9% gross margin. No way in heck would I have even considered this company. 9% gross margins is not good. They had a negative net income and then they just exploded in 2021. Gross margins definitely improved. Net income positive. They were profitable. They're still profitable. So this was a turn of a century. Their revenue has been pretty consistent. It did take a hit. It took a minor hit. Total revenue took a minor hit. Gross profit exploded. Operating expenses increased. Cash was okay. I mean, what's their quick ratio right now? Their quick ratio is over 1, so that's okay. That's fine. Total assets 2.3 billion. Total liabilities 882. That's good. Total debt is 10 million. That's really good. So back in 2020, they had 1.6 billion in assets, 1.4 billion in liabilities. That's crazy. That's freaking risky as heck. This is something I would not have gotten in. That's like way out of my comfort zone. Way, way, way out of the comfort zone. I mean, they're shared. I mean, look at the shares float though. This is amazing. See, this is the part of the reason like why you have to consider shares float. Because like if the company has low shares float, it can really be moved. So this is what let's run through the numbers. We do have a combination of millions over here and billions over here, so everything does have to be typed out longhand. So we have 3,940,000,000 in sales plus 1,320,000,000 in income. Correct. Plus the market cap is over $1 billion, so we do include it in the calculation, 2.27. And we're going to add cash, remove debt. So they have plus 301,910,000 in cash. Total debt is 10,970,000. Yep. So dividing this by 13 million, $600 stock price, which we know is not. I mean, the stock market will let you know how much a stock is worth, but that just goes to show the power of low float stocks. Like it really, really went for a ride here. Oh my God. So if I were to be viewing this, I would look at the shares float under 100 million. The quick ratio, what was their cash back in 2020? Cash in 2020 was half of what it was, more than half. No, less than half. So quick ratio was 2.6, so it would have been 1.3. So that would have been a quick ratio over 1.3. Earnings per share. Oh, I didn't look at earnings per share. That's fine. We'll keep it ambiguous. So the more metrics we leave out, the more ambiguous it will be. So we'll have a bigger casting net per se. So profitable. Were they profitable in 2020? No, but we would have looked here. 2021 would have been like the ideal. Yeah. So I think with all of these metrics we have, gross margin 60 plus, this is 42. What was it? It was really low. It was really low in 2020. 2021, what was their gross margin? We didn't look at that. So 2021, we're going to do 2258 minus 677. 2258. 25% gross margins. So let's do a range, 25 to 60%. Range there. Operating income positive. Yes. Was there operating income positive back then? 2021, yes. But that's the tail end of 2021. Let's look at the quarterly. So I think -2. Positive to -5. -5, that's fine. Institutional ownership is 75% here, but what was it back then? This is AMR. 2021 again, someone's being pretty smart about this. What was the institutional ownership back then? 72. Okay, yeah. 72. Let's just do 70. Shares float is under 100 million back then. Let's duplicate this. We're going to go back to Den really quick. Oh. Okay. Yeah, their institutional ownership was high. Okay. Good to know. Good to know. And let's just double check our other RSI was below 50. What was RSI here? RSI was 36. Okay, so yeah, it still fits. Debt. Ooh, debt was kind of high here. Let's do debt under 2. Yeah, debt under 2. Quick ratio, I mean, yeah. I mean, if we do under 1, it's going to eliminate ones like this. So quick ratio, what was the quick ratio here? 0.4. So if we do 0.4 and above, it'll capture 0.4 plus. Okay. All right. Let's move on to the next one, and then we'll create a screener, and then we'll go through stocks because I know I'm eating away your guys' time. CPI car group PMTS. I mean, yeah. All right, here we go. Was around $2, went to $40. Okay, so 2019, 2020. Okay, so just beautiful. This is beautiful. This is all looking good. So we would have wanted 2019 numbers, right? 2019, yeah, 2019, 2020 numbers. 2021 is too late. So 2019 is when we would have wanted. So 2019, so 278 minus. I'm looking at the gross margins here. Divided by 278. 32% gross margins, which fit right in between the 25 and 60. Okay. Operating income was positive. Yeah, this is for back in 2019. Net income negative, but they went positive. So net income says profitable, but let's look at -5 to profitable. Okay. Let's look at their cash. So they had 20 million cash. They had more cash then than they do now. So their quick ratio is above 1, so that's healthy. That's good. 2019. Assets were 92, liabilities were 41, so that's a 2-to-1 ratio there. Okay. Let's look at institutional ownership. So we're gonna do PMTS. 20. Nothing. Nobody grabbed anything in here. I think we can see if we go to Fintel and we go to PMTS. We might be able to see by the year. Yes. Okay, so 2019, let's do the latter half of 2019. So share price. This is ownership. So is this in millions? So it is half of. So share price was 22? No. I'm sorry, the share price is this black line right here that we can see. So the share price was, again, like $2, and shares owned was 1,000 times 1,000. So I'm getting that from right here, 1,000, and then times 1,000 right here. So 1 million shares were owned back in 2019. And if we go back to here, shares outstanding in 2019 was 11.2. So divided by 11,200,000. Is that 81 or 89? Did I get that right? Institutions owned 1 million shares. Now it's double that. So institutions own 10%. So that's a huge ranging gap. That is a huge ranging gap, and I don't think that would hit our criteria because if it's, I mean, but I should be going off of shares float. I should be going off of shares float and not shares outstanding. That's right. Okay, I messed up. So we got to take the 1 million divided by 4 million. So it should be like 70. Nope. Okay, 4 million minus 1 million is 3 million divided by 4 million times 100. No. Why am I getting this so wrong? $4 million minus 1 million shares owned. Okay, here we go. Times 75%. Okay, so 75% of the shares were owned, which institutional ownership. Okay, so it does fit within our range. That's good. Shares was under 100 million, and if we look at the RSI for this back here, wow, the RSI was under 30. That's crazy. That's very crazy. So it hits this, hits this, hits this. Debt under 2. How was their debt situation? Total debt 296. 2019 was 313, so it was a little bit more. So it's not showing the debt. That's a bummer. So this would be excluded, like stocks like this would be excluded from our search because it's not populating here. So if we wanted to broaden our basket, we would want to remove this. Quick ratio less than 4 plus, yes. Net income. Net income was negative, yeah, 0.5. Operating, yeah, we caught that. Okay, so I think we've got the information to look and create a scanner. So let's now create a scanner based off of these metrics. So let's pull up our little sheet. I'm just going to move it over to this screen really quick. So gross margins were 25% plus. So where's gross margins? Over 25%. All right. Operating income was -5 to positive. So operating income. Operating margin, damn. Custom. So -5 to positive. Okay. And then net income, -5 to profitable. I don't know if net income is here. Net profit margin. Not quite. They have profitability here. Let's see. Profit. Oh, profile. So we can do, again, custom, and this was, sorry, operating income, no. Neg 5 to profitable. Neg 5. Okay, quick ratio, again, we're gonna do, custom 0.4 plus, so that's good. All right, institutional ownership, this is gonna be a big one. Institutional ownership is gonna be high, over 70%. Shares float under 100 million. RSI below 50. Less than 50. All right. And I think gross margins, operating income, net income, quick ratio. So we have 367 stocks to go through. This is going to be a whole separate video in itself because that is a lot of stocks to go through. But again, you know, all of these stocks were under $20. So I think, was AMR under 20 bucks? Denbury was, let's see really quick. So we're going to go back through these ones. Denbury was, I think, 15. Let's see. Denbury was, yeah, under, I mean, we wouldn't have caught it till here. Let's do under $50. So price is under 50. Yeah. All right, now we have 157 stocks to go through. Okay. I'll make this a separate video. We just looked at the highest compound annual growth rate stocks. Come back next time, and this video is going to follow. What we're going to do is, I guess, review 157 stocks. And these are all based off the CAGR. So if you made it this far, please consider hitting the subscribe button, and I will talk to you guys later. Hope you're doing well.